life insurance, an asset or a liability? In this episode, I'm going to address 3 ways that life insurance can be classified as a significant asset rather than a liability for the owner. By the end of this episode, you will understand how max-funded IUL is used for living benefits by many savvy investors. So my name's Doug Andrew. I've been a financial strategist and a retirement planning specialist now for more than 48 years, helping people prepare for a comfortable retirement and other long-term financial goals so they won't outlive their money. And if you've watched very many episodes on this 3-dimensional wealth channel or read any one of my 12 books that I've written thus far, you will probably discover that one of my favorite financial vehicles that allows people to accumulate their money tax-free and then be able to create tax-free income for as long as they live without depleting principal, and then be able to leave behind the money tax-free and have it actually blossom or increase in value, is a maximum funded, tax-advantaged insurance contract. Now, my favorite is an indexed universal life insurance contract, structured properly and funded correctly. This is what is deemed a laser fund. LASER is an acronym that stands for Liquid Asset Safely Earning Returns. And so I would dare say that over 99% of IUL policies actually don't qualify to be a laser fund. And you can learn about why and how in these various episodes on this channel. And I'm going to gift you a copy of our most recent best-selling 300-page book, The Laser Fund. So stay with me here. But folks, this is incredible. A lot of people don't think about life insurance as an asset. So I'm going to give you a few examples as we go through right now. Indexed Universal Life allows you to link your returns, if you choose, with your universal life policy to an index of your choice. This is very valuable in a low interest environment, which started happening in the late 1990s. When Universal Life was first introduced by E.F. Hutton, who was not an insurance company, they were a brokerage firm. It was in 1980, and interest rates were high. And insurance companies were earning and paying on Universal Life, the ones that I owned, between 11.75% and 15.5% tax-free from 1980 to 1990 and a few years beyond. Interest rates started to come down, and so to compete, they introduced indexed Universal Life because people didn't want to have their money subject to volatility. That was variable Universal Life or variable whole life. I've never owned one. I never will. I got my 3,000 clients out of the market in 1980 when E.F. Hutton came up with the idea of Universal Life. They were never happier, and they were able to earn great tax-free rates of return. But when interest rates started coming down, I didn't want them to put their money back into the volatile market. That's variable life. So indexing allows the insurance company to take the interest on your money in the policy. And it doesn't matter if you have 100,000 in there, 10,000, a million, 10 million, but let's use a million just to use as an example, a snapshot in time, and it's easy to extrapolate from $1 million example. So if the insurance company is earning in a low interest environment on AAA bonds and mortgages on shopping malls and skyscrapers and so forth, 5%, they need one of those percentage points for themselves, and so they can pay you 4%. So that's $40,000 on your million. You can settle for 4% tax-free, because it is tax-free, which is better than what banks are paying. But if you feel bullish about America and you want to earn a return that outpaces inflation, which in the year 2021, the true rate of inflation was 15%, people who owned indexed universal life earned 25%, 61%, even 153% who followed our advice, okay? So with indexing, you're simply telling the insurance company in that year, or sometimes you can use a 2-year or a 5-year period, hey, I will give up the interest on my money, but keep my million safe in this example. And if it's 4% they're earning, that's $40,000. You can use that $40,000 to fund an options budget so that you'll have the wherewithal to pay me whatever the S&P or the Dow Jones, what the market does, if it goes up. If it goes down, the options expire worthless, and I didn't make anything, but I didn't lose my million. I do that because 7 out of 10 years, you'll usually have the market go up. You'll usually make money. Even in the worst decade since the Great Depression, 2000 to 2010, when there were 5 down years, I ended up doubling my money in that 10-year period. $1 million doubled to $2 million, even though 5 of the years I didn't earn anything or much of anything, and the other 5 years I did. That's the beauty of indexed universal life. So let's talk about this as an asset. Many people that would come to me wanted to use life insurance as a living benefit, because that's what E.F. Hutton came up with the idea instead of just the death benefit. But you can use it for either one. So when E.F. Hutton came up with this idea, it had universal applications. That's why they called it universal life, which means you could minimum fund it. You could pay actually lower premiums into a universal life than a whole life policy and get a death benefit. So if all you wanted was tax-free transfer when you died, universal life allowed you to pay lower premiums into it than whole life. Whole life had to compete, so they had to pay higher interest rates and so forth. And they used to have guarantees. Now they don't, but they would say, well, a universal life, if you pay minimum premium, can cause you to have to pay higher and higher premiums down the road. It'll lapse. No, not if you do it correctly, but if you do the opposite end, you take the least amount of insurance the IRS will let you get away with, and you put in the most premium, you way overpay for the insurance. Now it turns into a tax-free cash cow for living benefits, to use it for tax-free accumulation and tax-free income. So for example, a 60-year-old could put in $500,000. You could get a lot of life insurance for that, but that's not the objective. The least amount of insurance for a 60-year-old might be 2.5 times that, $1,250,000. But that means the $500,000 they would put into a policy would grow and double like every 7.5 years if they're earning 9.6% like I've earned since 1997. And so this is incredible because, if you double your money every 7.5 years, 500,000 goes to $1 million, and then 2 million, then 4 million, then 8 million. Yep, we've had many people that started out with $500,000 that now have 8 million. Now, before I show you something absolutely incredible, if this is intriguing you, click like, but post a comment, share with somebody else who ought to watch this, but subscribe to this channel. It's free. When you subscribe, also click that little bell. It notifies you every time I post a new video, which I do almost on a daily basis, and I don't want you to miss out. But this is about you and your brighter future. But stay with me to the end because I want to gift you my most recent best-selling book. You don't need to pay $20 for it on Amazon, okay? Now, let's talk about why many IUL policyholders maximum fund to use it for living benefits, because every million can actually generate a 10% payout. $100,000 a year of tax-free income without depleting principal if you retired at 65, if you live to be 120. Sound too good to be true? You wouldn't believe how many IRAs and 401ks will be out of money 10 or 11 years after retirement because you're having to pay tax on it, and it's not designed to outpace inflation. In the year 2021, people who had indexed universal life when inflation was 15% were earning 25, 61, 153% by linking their returns to the things that inflate. If that is arousing curiosity in your mind, make sure you search on this channel for that, but also read the book I'm going to gift you. So let's talk about the beauty of an insurance contract as an asset. So there are 5 general parties to an insurance contract, an insurance policy. Now there's the insurer, that's the insurance company. There's the insured, that's the person that the insurance is on, okay? There's the owner of the insurance policy. Now, the owner is usually the insured, but it doesn't have to be. Many banks and credit unions own insurance policies on people. Why? Well, because they get the tax-free accumulation and the tax-free income. They're just putting the insurance on their stockholders or their board of directors or what have you. There's a lot of companies that actually buy life insurance policies from people who no longer want or need them, and I'll talk about why here in just a moment. So you have the owner. It doesn't have to be the insured. You have the premium payer, the one putting the premiums into it, which is usually the owner and the insured, but it doesn't have to be. I could be the premium payor as grandpa on a policy that insures one of my children, and the beneficiaries is the family trust that benefits the grandkids, okay? So that brings up the fifth party. That's a beneficiary. That's the one who gets the money when the person dies, the insured dies. So far, so good. There is such a thing as insurance capacity. A lot of people don't understand this. That means that when you're younger, let's say you're 30 years old and you have 6 children like my wife and I did by the time we were age 32, if I were to die, I wanted to protect my sweetheart and my 6 kids so that they would have the wherewithal to be able to continue to live life in dignity and go to school and have music lessons and so forth, because I didn't stay around to provide that. And so you're able to insure yourself for a certain factor of your income. Let's say it's 30 times your income. If you're making $100,000 a year, they'll let you have $3 million of insurance. Yeah, you can't have as much as insurance as you want. It's a factor of your income. Now, otherwise, people would be buying billions of dollars of insurance, these terrorists, and they would strap bombs to themselves and blow themselves up to fund millions of dollars of their terrorist groups, okay? And so that's called insurance capacity. You can only have a certain amount of life insurance based upon your income or your net worth. Later on, as you get older, what happens? When you're in your 60s, the kids are out of the nest, hopefully. And you have fewer years if you were to die. And so the insurance company might only give you 6 or 8 times your income, or they'll insure you for maybe 1 times your net worth. And people will use insurance to pay off estate taxes or what have you. And so that's called insurance capacity. But many times I've had insurance capacity based on my net worth or my income, even when I'm 60 or 65 years old, that is more than I'm using. People say, why buy insurance if you don't need it? Well, look at what it does. And so I have told my kids, I want you to be automatic millionaires when I die. I want you to all buy $1 million life insurance policy on me. You're the owner. You're the premium payer. I'm the insured. So they own $1 million policy. They put in, $500, $600, $700 a month. Do the math. If you put that much money in an IRA or 401k, it would take over 30 years at 11 or 12% interest for them to net $1 million after tax on an IRA or 401k. If they put that into a policy on me, they're going to get $1 million anytime when I die. And I'm not immortal. I'm going to die someday. And that $1 million can generate $100,000 a year of tax-free income for as long as they live by putting it into a new IUL. I just did this for somebody who lost actually their grandparent. So look at what it does. It'll knock the socks off of an IRA or 401k in my opinion. But many times people, as they grow older, if they no longer want the insurance, the death benefit, or no longer need it or can afford it, sometimes they just go, just let it go, just let it lapse. Well, I've had people do this where they think, well, I'm just going to let it lapse. I don't need it anymore now. They've been minimum funded it or whatever. And I go, whoa, hold on. It's an asset. They go, what do you mean? It's a liability. I'm having to pay premiums and I'm not going to enjoy the benefit. It's going to go to somebody else when I die. I'm going, yeah, look at what it does. Now, there is a market called the life settlement market. The life settlement market is simply where you can shop a market of institutions that will buy life insurance policies. Why? Because they do the math. So I've had people who have $1 million policy, a $3 million policy. They no longer want it or can afford it. And they shop it among these life settlement companies. And they have investors, and they may give you, $500,000 for that $3 million. They may give you $250,000 for $1 million policy, cash. Unless that exceeds the amount you paid into it, it's tax-free. So before you just say, let it lapse, contact me. I can point you and shop for you. You can check me out on 3dimensionalwealth.com and let me know you're interested. And I can point you to that. But I've helped many people that have $1 million insurance policy get $150,000, $200,000, $250,000 of cash out of it instead of just letting it go by selling it to somebody else. Now, they now own the policy and they have to pay the premiums, but they get $1 million when you die. Do the math. And so don't just give it up. It's an asset. If you have $2 million, $3 million, I was able to help somebody that had a little over $3 million of insurance get nearly $1 million out of it that they were going to just give up if they just let it lapse, okay? So make sure you understand that insurance can be an asset, not a liability, and you check out all the possibilities. That's why I love the flexibility behind insurance, especially indexed universal life, because it's the most flexible. So to claim your free copy of the Laser Fund, the Laser Fund is a properly structured, maximum funded indexed universal life. Go to the Laser Fund or just laserfund.com. Click on that link below, and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book and fire out a hard copy to you. This is actually 2 books in one, 300 pages. 200 pages are the charts and graphs. Another 100 pages, when you flip it over, are the stories, 62 of them. And so claim your free copy, and there's options there to listen and learn, watch and learn. There's even an 18-hour master class that my 2 sons and I, who are co-authors of this book, do with a very deep dive into these concepts. But claim your free copy and check out some of our virtual events that we do on a regular basis, because this is for you, your brighter future.